Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way. Right now, according to the data, everyday investors in the US are trading like 20 million 0 days to expiration options contracts every single day.
Yeah, 20 million. It's wild.
Right. That is 20 million bets that expire in just a matter of hours. I mean, the stock market has basically been transformed into this casino that moves at the speed of light.
It really has. It is a completely unprecedented environment for the everyday retail investor. The amount of fragility built into the system right now is just, well, it's astonishing.
Which is exactly why we're doing this deep dive today. We've pulled together recent analysis, market data, behavioral economic studies to really focus on one singular critical theme for everyday Americans who are just trying to build wealth.
Right, and it's such an important topic.
It really is. Our mission today is to figure out how to stop playing the game of perfect prediction and, start playing the game of ultimate survivability. Because looking at this research, surviving your wrong guesses is actually the secret to long-term wealth.
Exactly. That shift in mindset, I mean, that is the difference between someone who retires comfortably and someone who just completely blows up their account.
Yeah.
The current data shows we are in an era of extreme risk-taking. U.S. margin debt hit a staggering $1.5 trillion at the end of June.
Wow.
Right? It's a 49% jump from the previous year. And all of this manic, highly leveraged trading is concentrated really heavily in just a handful of assets, mostly the S&P 500, NVIDIA, and Tesla.
So we basically have this mountain of debt, rapid-fire options trading, and everybody is just crowding into the exact same three doors.
Pretty much, yeah.
So for a beginner investor, maybe they're listening to this on their commute, just trying to make sense of all the noise. What is the fundamental danger here?
Well, the danger is that using leverage, which is simply borrowing money from your broker to amplify your purchasing power, it completely strips away your single most valuable asset.
Which is?
It takes away your time to be wrong.
Okay, break down that mechanism for us. How does borrowed money take away your time?
Sure. So let's say you have $10,000 in cash and you use it to buy shares in a fundamentally strong tech company.
Right, makes sense.
A week later, some sudden macroeconomic panic hits and the stock drops 30%. You are now down $3,000 on paper.
Ouch. Yeah, nobody likes seeing that.
No, it hurts. But because you own those shares outright, you have the luxury of time. You can review the company's balance sheet, see their revenue still growing, and you simply wait.
Right, you just give the market time to realize that its panic was a mistake.
Exactly.
I mean, it's agonizing to look at the red numbers in your account, but I haven't actually lost my position in the company.
Right, you're still in the game.
Right.
But if you introduce leverage, the math becomes violent.
Violent. How so?
Let's say you took your $10,000, but you used margin to borrow another $10,000 from your broker.
Okay.
So now you buy $20,000 worth of that exact same stock. When that 30% drop hits, your position loses $6,000. Your actual account equity shrinks to just $4,000.
Oh, wow. And, the broker isn't going to just sit around and hope the stock recovers, right? They want their $10,000 back.
They want it immediately. You cross their safety threshold, and they issue a margin call.
Right.
If you cannot wire cash into that account that very same day, the broker forcefully liquidates your shares. They sell your stock at the absolute bottom of the dip.
So you're just done.
You're done. And the real tragedy is that maybe 2 years later, that company innovates, dominates its sector, and triples in value.
So your initial research was actually brilliant.
Absolutely brilliant. But the leverage forced you out of the game before you could be proven right.
That is wow. I mean, that makes me think of driving a car. Using leverage is basically like driving 120 miles per hour just to get to work 5 minutes faster.
That's a great analogy, actually.
Right. Like, sure, if the road is perfectly paved and totally empty, you feel like a genius. But if you hit a single normal pothole, a standard market dip,
No,
you don't just get a bumpy ride.
no, you don't.
The margin call is the equivalent of your steering wheel completely locking up the second you hit the pothole. You lose total control of the vehicle and crash.
Exactly. And we actually saw that exact crash play out structurally in the South Korean market in the summer of 2026.
Right. The recent analysis of that event is basically a perfect case study for this.
It really is. There was this immense, totally justified excitement around artificial intelligence and semiconductors. But between June and early August, Giants like Samsung and SK Hynix dropped around 33%.
Just massive drops.
Yeah, and those two companies alone drove 76% of the overall market collapse.
Okay, but let me push back on that for a second, or at least ask the obvious question. AI demand didn't just vanish in July.
No, of course not.
Right, like data centers were still being built all across the US. The business fundamentals for semiconductors were accelerating, so why the massive plunge?
Because the fundamentals didn't break. The leverage broke.
Ah.
The culprit was largely single-stock leveraged ETFs. These are, funds designed to multiply the daily return of a single stock.
Okay.
And here's how the mechanism actually works. To maintain that multiplier effect, the fund managers are mathematically forced to rebalance their books at the end of every single trading day.
Meaning they basically have to buy more when the stock goes up and sell when the stock goes down.
Which is the exact opposite of what a smart investor does.
Right. Buy high, sell low, basically.
Right, exactly. So the stock price drops a little bit due to just, normal volatility.
Mhm.
At the end of the day, these leveraged funds are forced to sell shares to rebalance.
Which pushes the price down even further.
Yes. And that lower price triggers margin calls for everyday retail investors, forcing their brokers to sell.
Which pushes the price down even further.
Exactly. It becomes a doom loop,
Mm.
an avalanche that is entirely disconnected from the actual value of the microchips those companies are producing.
Man. Okay, so I understand the structural risk of the doom loop, but what if I'm, say, a 25-year-old listener with a small account?
Sure.
I've done weeks of research, and I have absolute, undeniable conviction that a specific software company is going to rule the world. Don't I need to bet heavily, maybe put half my portfolio into it to actually build real wealth?
See, that is the most common trap in investing.
Yeah.
You absolutely must learn to separate your conviction from your position size.
Separate them.
Yes,
Ah.
even generation-defining companies experience 30 to 50% drawdowns due to macro events that are totally outside their control.
Right.
A war breaks out, a supply chain collapses, or, like we just talked about, a leveraged ETF unwinds. Should only ever risk an amount of capital that allows you to survive if your prediction turns out to be catastrophically wrong.
Which ties directly into the behavioral economics research we reviewed for this deep dive. I mean, if we manage to survive the leverage trap, we still have to manage our own brains, right?
Oh yeah, that's the hardest part.
The data on how everyday investors handle their winning and losing stocks is just fascinating. Specifically, this phenomenon called the disposition effect.
Yeah, human psychology is almost perfectly wired to be terrible at investing.
Right.
The disposition effect shows that we habitually sell our winning stocks way too early just to lock in a small profit, and we hold on to our losing stocks way too long, hoping they bounce back.
It's like being the general manager of a sports team, but you're operating entirely on ego.
Oh, that's a perfect way to look at it.
You draft a rookie who turns into a phenomenal superstar, but the second another team offers you a tiny cash bonus, you trade him away just to secure a quick win.
Right.
Meanwhile, your first-round draft pick is a complete bust, costing you games every single week. But instead of cutting him, you keep him on the starting roster, because cutting him means holding a press conference and admitting to the fans that you made a terrible decision.
Exactly. That ego preservation is exactly what destroys portfolios. When a stock is down 20%, clicking the sell button turns a paper loss into a realized loss.
You have to admit you were wrong.
Yes. It forces you to face reality. So instead, you hold on to the underperforming asset, just praying it gets back to the price you bought it at so you can break even and save face.
So you're making financial decisions based on emotional comfort rather than, business reality.
Precisely.
So how do we debug our brains? Like, how do we evaluate a stock that is bleeding red in our account without letting ego take the wheel?
By never judging an investment purely by its share price.
Okay.
You have to evaluate it strictly by the original thesis, the specific business reason you bought it in the first place. Let's look at two scenarios to really clearly establish this rule.
All right, lay them out.
Scenario A. You buy an AI tech firm because you see their profit margins expanding and their enterprise software is taking market share.
Sound like a solid plan.
A month later, the broader market experiences a correction and your stock drops 20%.
And panic sets in. I want to sell.
But you pull up their latest quarterly report instead. The report shows their margins are still expanding, and they just signed 3 massive new enterprise clients.
Okay.
The conclusion is simple. Keep the stock. The thesis is entirely intact. The share price is just temporarily responding to macroeconomic noise.
It's like the superstar player just had one bad game because it was raining. You don't cut him from the team.
Precisely. Now, scenario B. You own a consumer brand, and the stock only drops 5%. It barely hurts.
Right.
But the news breaks that they just lost their main manufacturer, their debt financing fell through, and a competitor just launched a cheaper, superior product.
Oh, boy.
The conclusion here, sell it immediately. The business thesis is fundamentally broken.
Wow.
The reason you invested no longer exists, regardless of how small that price drop actually was.
So cut the bad players ruthlessly and let the superstars run.
Exactly.
But if we are managing our individual positions correctly, how do we protect the entire portfolio from a systemic shock? I mean, the traditional advice is diversification.
Right.
But looking at the recent analysis, most American retail investors are practicing what amounts to fake diversification.
Yeah. Fake diversification is a huge problem. People look at their brokerage app and they see, a U.S. tech fund, a European industrial index, and an emerging markets ETF.
And they feel incredibly secure.
Right. They assume they're safely spread across the globe and across all these different industries.
I'll challenge you on that, though. I
Right.
mean, how is a software developer in Silicon Valley mathematically connected to a factory in Germany or a mining operation in Brazil? They operate in totally different economies. Why is that fake diversification?
It's fake because of how deeply intertwined the global macroeconomic plumbing has become. And it's heavily driven by algorithmic trading.
Okay, explain that.
Let's look at the current landscape. Under the current Trump administration, if the U.S. government enacts sweeping economic policies, like, say, broad tariffs,
Right.
or if the Federal Reserve signals higher interest rates for longer, what happens? The U.S. dollar surges in strength.
Which makes U.S. exports a lot more expensive, hitting the tech sector.
Yes. And that strong dollar simultaneously crushes emerging markets that borrow in U.S. dollars because their debt suddenly becomes way more expensive to service.
Ah, I see.
Meanwhile, the European industrials that rely on global supply chains and emerging market demand, well, they see their orders dry up.
Wow, so it all dominoes.
Exactly. And the algorithms that control trillions of dollars in institutional wealth, they don't look at these as separate companies. They look at them as a single risk-on asset class.
So they just dump everything.
When the macro environment shifts, they sell all of them in milliseconds. They all fall down the exact same elevator shaft at the exact same time.
That's wild. It's like packing for a vacation and filling your suitcase with 5 different pairs of sunglasses.
Huh.
You look at your bag and think, wow, look at all this variety. I have aviators, I have sports frames, I have polarized lenses.
You feel very prepared.
But if you arrive at your destination and a hurricane hits, you have absolutely zero protection.
None.
True diversification isn't just owning more sunglasses. It's packing an umbrella, a heavy winter coat, and waterproof boots.
That is the perfect distinction.
Hmm.
True risk diversification means holding asset classes that respond fundamentally differently to economic weather.
Right.
You need an umbrella for inflation, which might mean holding certain commodities. You need a winter coat for recession, which traditionally involves high-quality government bonds. And you need a foundational layer of resilience, which is just good old-fashioned cash.
So you're diversifying your exposure to risk factors, not just geography.
Exactly.
So this brings us to a really massive realization. If global markets are this tightly correlated and algorithms are moving trillions of dollars based on complex macro events that no human being can actually reliably predict, then trying to have a really high win rate is kind of a fool's errand.
A high win rate isn't just a fool's errand. In modern finance, boasting a super high win rate is actually a massive red flag.
Okay, see, I need you to explain that because it sounds totally backward.
I know it does.
Right. Like, if an institutional hedge fund's quantitative model is winning 90% of its daily trades, doesn't that just prove their math is incredibly accurate? Why is success a red flag?
Because of the hidden asymmetric risk they are taking to achieve that win rate. Let's go back to those 0 days to expiration options we discussed at the top of the show.
The 20 million daily bets.
Right. Many automated strategies are built around selling these options. By selling them, you collect a tiny, reliable premium.
Okay.
Because the options expire in just a few hours. 90% of the time, nothing crazy happens. The option expires worthless, and you keep your tiny profit. You feel like a genius picking up $1 off the ground every single day.
But what happens on the day the market violently swings?
Well, on that 10% day, the market gaps down. The options you sold are suddenly in the money, and you are on the hook for the massive difference in price.
Oh, no.
That single long-tail loss is mathematically designed to not only wipe out your previous 90 wins, but to completely obliterate your entire account balance.
Wow.
You are risking catastrophic ruin just to secure small, frequent dopamine hits.
And we saw this exact dynamic fracture the market in July 2026.
We did.
I mean, some of the most well-resourced hedge funds on Earth gave back enormous portions of their yearly returns. And the research shows it wasn't because their analysis of tech earnings was flawed.
No, not at all.
It was because they were all standing on the exact same side of the boat, utilizing similar algorithmic strategies. When the market narrative slightly turned, they all rushed for the exit at the exact same time.
And the door was simply too small.
Right.
And the ultimate irony is the rebound. Just weeks later, by August 7th, the S&P 500 had violently reversed course and bounced back to all-time highs.
It's completely recovered.
The macro narrative flipped from panic back to euphoria in the blink of an eye. But if you were heavily leveraged or if your algorithmic strategy blew up in July, you were forcibly liquidated.
You didn't survive long enough to participate in the August rebound.
Exactly. You were already wiped out.
Okay, so if the goal is absolute resilience over perfect prediction, how do we practically train ourselves to be resilient? For the beginner tuning in, how do we build that muscle?
It starts with completely overhauling how you track your progress.
Okay, how so?
Well, most beginners keep a trading journal, but they use it like an accountant's ledger. They write down, I made $200 on Apple today, or I lost $50 on Tesla.
Right, just tracking the money.
But that tracks the outcome, which you cannot control. It does absolutely nothing to improve your process.
So what should we be logging instead?
Your journal must track your psychological behavior. It should answer one core question. What behavior or mistake am I continually repeating?
Oh, interesting.
Look back at your last 20 losing trades. Did you buy a stock purely out of FOMO because your neighbor made money on it and you felt left behind?
Oh, been there.
We all have. Or did you size a position way too large right before a really volatile earnings report?
Or did you engage in revenge trading? I think every investor has felt that specific venom.
Oh, absolutely.
You take a $100 loss that was perfectly managed according to your plan, but it hurts your ego. You get angry, the neuroscience of tilt takes over, and 10 minutes later, you make a completely reckless, unplanned trade just to win that $100 back.
Yes.
And you end up losing $500.
That is exactly what a behavioral journal catches. You have to debug your own brain because you cannot debug the global market.
Right.
You can have the most sophisticated financial models in the world,
Yeah.
but if your psychology is fragile, you will continually find ways to sabotage your own wealth.
Wow. Let's talk about the final and maybe the most psychologically difficult piece of this resilience toolkit, holding cash. Cash. The prevailing advice online is that, cash is trash. Inflation eats away at its purchasing power every year. Holding a large cash position feels like you are losing the game, especially when everyone on social media is posting screenshots of their massive tech stock gains.
It requires immense psychological armor to hold cash during a bull market. Beginners view cash merely as this defensive drag on their portfolio. But when you reframe how you look at it, cash is actually the ultimate offensive weapon.
Okay, how so? Explain that.
Think of cash as a call option on every single asset class in the world, but with no expiration date.
Oh, wow. I like that.
When a massive systemic shock hits, when those leveraged ETFs cause a doom loop and force institutional players to liquidate truly world-class companies, suddenly go on a 40% off sale.
Right.
The leveraged investors are trapped. They're forced to sell just to meet margin calls. But the investor who endured the boredom of holding cash...
They get to swoop in.
Exactly. They get to step into the wreckage and buy great companies at generational discounts. Cash is the tool that allows you to capitalize on the mistakes of the leveraged crowd.
That makes total sense. This has been just an incredibly clarifying look at the realities of the modern market. Let's synthesize what we've uncovered from all this 2026 data.
Sure.
A successful investor isn't some mythical guru who can accurately predict the Federal Reserve's next move or guess the exact inflation print or, time the absolute top of a semiconductor cycle.
That person just does not exist.
Right. A genuinely successful investor is someone who ruthlessly cuts their bad investments before they fester. They give their winning assets the oxygen and time to compound.
Yes.
And above all, they structure their financial lives through true asset class diversification, careful position sizing, and a complete avoidance of margin debt to survive a string of 3 completely wrong decisions without getting wiped out.
Surviving your inevitable mistakes is the absolute prerequisite to enjoying any long-term success.
Which brings us back to where we started. In finance, there is no clean black and white x-ray that will tell you exactly what to do. So I want to leave you, the listener, with a final provocative thought to chew on today.
I love this part.
Take a hard look at your current portfolio and your internal mindset. If your entire strategy requires you to be smarter than the collective global market every single day just to avoid ruin, are you actually investing or are you just feeding your own ego?
That's the real question.
Ask yourself, what would happen to your financial life and your family's security if you were dead wrong on your next 3 major financial decisions? If the answer is total disaster, you don't need a better stock pick. You need a completely new game plan. Don't forget to subscribe and hit that like button.